And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Thursday, the second best day of the week. That also means that Michael Lebowitz is joining us this morning to talk a little bit about markets, where we're headed, what we're thinking, what we're looking at, all those type of things. We'll get into that today. Importantly, though, the Burrito indicator is now flashing red. And Brent missed the whole best title for the show today. So just, there you go. He normally asks me in the morning, he says, what do you want to name the show today? Well, he didn't ask me today, so he missed out on the good headlines. But the Burrito indicator, that's the Chipotle Mexican group. Of course, they make the world's most expensive burrito, if you've been to Chipotle lately, to have dinner. But anyway, they're starting to see some sales slow down as consumers are starting to retrench here a bit. And this is something that we've been talking about here for a while, is that there's clear evidence that the economy is slowing down, right? There's no doubt about that. And that's going to put pressure on retailers, service providers, et cetera, to cut costs and also to cut prices so they can sell their services, right? So again, start looking, and these are always kind of good kind of indicators to look at. And this one, we look at Walmart, we look at Costco, we look at those type of retailers as well, look at foot traffic, because that tells you a lot about what's going on with the consumer. Now, we've talked about recent rising delinquency rates, those type of things, but be careful, right? Thinking that, this absolutely means a recession's coming. That is not necessarily the case. We're currently growing around 2.3% growth as of the fourth quarter. We're going to start getting first quarter GDP numbers here very shortly. But we still have to reverse all that growth. We have to go from 2.3 to negative growth to get to a recession. So again, there's a lot of room in the economy for the economy just to slow down, but not necessarily have a recession. Now, I'm not saying recession is off the, completely out of possibility. I'm not saying that at all. But there's a very large rising consensus of people going, recession's definitely coming. Well, that could possibly be the case, but recessions, as you know, are deflationary in the economy. That's going to weigh on corporate profits, it's going to weigh on earnings, that's going to put continued pressure on markets. Again, that doesn't mean the markets are going to crash, so don't go jumping off that ledge just yet. But we could, again, as we talked about earlier this year, that just continue to see this market kind of just grinding sideways within a fairly broad range. I mean, the markets could get back up to 5,800. We've got corporate share buybacks coming back starting week after next. We're currently looking at a near record for the first quarter buyback announcements by corporations. So they're certainly going to be in the markets in the next week or two starting to buy back shares. That's going to bring back an important buyer of the market that's been absent during this entire decline. So this is, the things that we're looking at, paying attention to, and of course this week on today we get Google's announcements after the bell, and then next week we've got Microsoft, Amazon, Microsoft, Amazon, and Apple next week. Now we won't get NVIDIA until May, end of May, because NVIDIA is always very late to report. But we're going to have the majority. We've already had Tesla. So we're going to have the majority of the Mag 7 announcing by the end of next week. Well, that opens all of them up for share buybacks. So as soon as they announce, they can start buying back shares. That's going to, and of course, those big mega cap companies, those are your largest buyers of corporate shares in the market. So when they return to markets, that's going to help at least provide a level of support for markets as well. So again, just as we kind of keep kind of navigating the cycle, yes, there's a lot of headline risk, tariffs, what's going on with Ukraine, et cetera. Certainly lots of headline risk here near term, keeping pressure on markets. But we have to get back to the fundamentals ultimately and just realize that we are going to have slower economic growth. That is going to weigh on earnings. That is going to weigh on markets. That doesn't mean, again, just be clear, we're not going to have a major crash here, but we could just be grinding out a bottom here for quite some time. So just be a little bit aware of that. But here's what you need to know before the bell this morning. Yesterday, decent day, had a second day rally. markets actually got back above the 20-day moving average. So this is the first kind of positive sign that we've seen here for a while. We tried to do that, just before Trump came out and announced the original tariff, the original tariffs, right? Those big, ginormous trade deficit tariffs that really kind of cracked the market. So, we're now trying to form a little bit of a bullish move here for the markets. We've cleared the first level of resistance. That's going to get you back up to about 5,600 if right, we can maintain this. Now, markets are looking to open a little bit lower this morning. So as long as the markets can maintain about 5350 today, maybe even end on the upside a bit today, that would certainly be an encouraging sign here for the markets near term. We are going to run into a lot of resistance, well, not a lot, but we have some decent resistance here coming up at these previous bottoms and these tops that just run right there. And of course, this was where we had this big giant 9% rally in one day. That petered out right at that resistance level. We've come back down. We are potentially setting a series of higher lows here. This is also bullish kind of in the near term for the markets. Markets are finding some buyers here, regardless of kind of the headline risk and everything else that's been going on. We're seeing some buyers coming into the market. So again, stepping in, we've had 6 days where we've had 70% positive stocks, right? So again, just that doesn't happen that often. It happens near bottoms of markets generally more often than not. So we are seeing some positive kind of momentum underneath the surface, and we're certainly seeing some buyers coming into the markets here. But again, we've got to break above this resistance level, and then immediately above that, we run into all this cluster moving averages. So that's kind of my point that I've been talking about here for a while, is don't expect this market to necessarily crash, and don't expect it to go running off to the moon. We're probably going to be stuck here for a while in just a big kind of grinding range that's going to just be very frustrating this year. And particularly when you've had a couple of years in a row where you've had 20% gains, it was super easy to make money. This is going to be that year that's just super challenging for the most part. And for the next few months, we could just be stuck here for a bit. Now, again, I think probably as we get to the end of the year, we get some relaxation, get some clarity on trade, get some clarity on tariffs, the market kind of starts to heal up a bit. But again, between now and then, this rally decline thing may very well be with us here for a while. It's going to be frustrating. It's going to be difficult to make money. But again, this is just one of those periods we're just going to have to navigate through without making really big, emotionally driven mistakes. Being too long, being too short, whatever it is. Markets are likely not set up for a major crash. They're also not set up here for a major rally. Again, that's going to be the frustrating part. You're just going to be stuck here for a bit and just have to kind of navigate through this. Outside of that, we take a look at what's been going on as well with crude oil prices, because this is kind of one of the big drivers for inflation right now as well. Oil prices feed into inflation, but demand drives oil prices, right? So as the consumer slows down, that's going to start to continue to weigh on oil prices. And oil's had a very nice little rally here. We've gotten up back above the 60 range. We'll see if we can hold on to this level. But again, it's running into a whole lot of overhead resistance here that's going to probably keep oil prices pretty well contained here near term. And this certainly suggests that two things. One is that inflation is going to continue to be under downward pressure, but also economic growth is certainly not showing up here, right? We're not having, kind of evidence of really strong oil demand within the economy. That's certainly not suggesting you have really strong, robust rates of economic growth. Again, these aren't recessionary levels of oil prices, but watching oil prices tells you a lot about the underlying economy. So again, just paying attention to that will also kind of help you kind of navigate what's going to happen here over the next several months. But that's what you need to know before the bell this morning. We'll come back. We'll pick up with Michael Lebowitz. We'll talk a little bit about the markets. We'll talk about the Jerome Powell-Trump feud, what happens next, and we'll talk about an update on the basis trade as well. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Get ready for our next open chat edition of Candid Coffee with Richard Rosso and Michael Lebowitz, Saturday, May 3rd. Anything you want to know, we'll try to find the answer.
How do I deal with all this volatility?
Is now the time to buy bonds?
Has Daddy been working out?
Register now and submit your probing question for Rich and Michael at realinvestmentadvice.com.
What's going to happen to Social Security?
Will the tariffs go away?
Where does Richard get his snappy jackets?
The open chat edition of Candid Coffee with Lebowitz and Rosso. Register at realinvestmentadvice.com.
Is that your bathrobe?
realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Of course, it is Thursday as we get this day underway. Markets are looking to be down just a smidge this morning. S&P's down about 10 points. Again, not really surprising after the rally over the last couple of days. But again, yesterday's rally was interesting because it came out of the gate. It was scorching hot coming right out of the gate. And then Bessent's been playing kind of good cop, bad cop with Trump lately. So he poured a little bit of cold water on that kind of mid-morning, and stocks kind of drifted off into the afternoon, but still finished on the upside about 1.5%. So it wasn't a terrible day yesterday. And importantly, like I said, we kind of got back above the 20-day moving average. So that's encouraging here. And again, we're seeing a lot of days now where we have 70% or more of stocks trading positively, right? And that's when you have that over a 2-week period, that is a generally a very good sign. And we've had numerous days like that over this last couple of weeks. So that's starting to show signs that the market's trying to heal up. Like I said earlier, buyers are kind of coming back into the markets. So there's some positive kind of price action despite all of this headline-driven volatility. But unfortunately, that headline-driven volatility isn't going away. Now, today we're going to hear from Google. Next Wednesday and Thursday is Microsoft, Amazon, and Apple. So we've got, as I was saying earlier, we've got a lot of big players coming into markets with earnings. We're going to get a lot of look at their outlooks. What's been interesting is so far, the earnings have been better than expected, right? Which is not surprising because we cut estimates, so everybody's kind of beating estimates. But the outlook's not terrible. We are seeing more and more companies withholding guidance here because it's just of the uncertainty of tariffs and kind of, do we have tariffs? Do we not have tariffs? Are they paused? Are they not paused? So they're withholding guidance, but the expectation was coming into earnings season is that nobody would give guidance. But we're actually getting some guidance from a few companies, and it's not terrible. It's not great, and some, we're hearing certainly about slowing customers and slowing consumers and those type of things. but it's not the disaster that kind of everybody was expecting going into earnings season. So that's another kind of an encouraging sign as well. But these are all the things that we're looking at, and Mike wrote an article yesterday talking kind of about pathways in the markets, and this is the big challenge, is trying to figure out what happens next. Where do we go to from here? Those are the issue. This is always the challenge with managing money, right? One side, you get one camp that's like, oh, the market's going to definitely crash, and we're going dramatically lower. You've got another camp saying markets are going up. Retail buyers, by the way, have just been buying the bazooka out of this market over the last week. We've seen a very big surge in retail buyers coming in to buy the dip, and then you've got kind of us that's just, I don't care what it's going to do, up or down. I just want to try to make some money and navigate this. So, Mike, what was kind of the result of your research on this? What did you figure out?
First of all, there was some good news this morning that you overlooked, Lance.
What was that?
The market's okay, but China said that it has had no discussions with tariffs with the administration. So that, to me, would have been, as soon as I saw the headline, I saw the headline before I even saw what the markets were doing. Mm-hmm. I was like, oh, no, here we go. Here's another down 100, 150, 200 day in the S&P because China's not behaving. And, the market's opening up down slightly. So maybe the market is starting to get used to this back and forth on trade, and one day it's good, one day it's bad, and can to some degree overlook it a little, not take every statement so literal, and realize it's part of a negotiation. So I'm not saying we're there yet, but that's a good sign if the market can kind of overlook statements from China, that something like that. So it's something, Lance. It's something.
It's something. We'll take a little of something.
Right. So I kind of wrote an article, and we've talked about this before, kind of what are the three likely paths ahead? And it's one's the rocket ship.
I'm kind of chuckling. I can see the comments coming now. I was like, these guys are really brilliant. Market go up, down, or sideways. This is genius.
Bam. You just ruined it. But that's the gist of it. Up, right. Down, or sideways. And if you remember a couple months ago when we were talking about what does 2025 hold in store, we were both kind of on the same page saying we thought we were going to be going up and down and ending up nowhere. Kind of called it the roller coaster scenario. What we didn't know is we kind of thought it would be like a Disney-like roller coaster where it's gently up, gently down, and you can take your little kids on it. Turns out to be one of those monster roller coasters with loops and plunges, and it's been a pretty big roller coaster so far, both up and down, and it's been very tough. But the three scenarios are really based around time. How long does it take to get these trade agreements in place? Are they beneficial? In other words, do we get to a better place than we were beforehand? And during that time period, how do consumers and corporations react? And my concern is the more time that it takes to reach agreements and to get comfortable, the more indecision, the more uncertainty there is, the more consumers will say, you know what, let's just hold off on buying a car or going on vacation or even going out to dinner. The more corporations will say, we can't invest in that plant until we know what's going on. I don't want to import. We've already heard of some orders for Christmas that are being delayed because they just don't know the tariff situation. So, the potential upside is quick resolution. And then Trump can start touting some of his other things like, potentially lowering taxes, deregulation, some things that are really business friendly that should boost the stock market. And then the flip side is the longer this wears on, the more economic pain it's going to take. And whether that's a slowdown to, much slower growth or a recession, I think it's still a function of time and the reaction function. So scenario A is basically where the market kind of works its way through all those moving averages and resistance points that Lance pointed out in the opening. We just got through the 20, there's a trend line dead ahead, and then you got a bunch of moving averages. So, the market in theory during this good scenario will hesitate during those points in time, but eventually we're talking new highs potentially later, even summer or later this year, because the tariff story is long gone and we're moving on to better stories for the economy, for the consumers and corporations. What we think is probably most likely is the roller coaster, where we slowly but surely do get some good tariff news, but China just lingers, and there are discussions, but it's going to just take a long time to get China out of the way. But every once in a while, you get a country like a Peru or a Malaysia or, something that has a trade agreement and it's beneficial. Maybe a Vietnam, something more pertinent to our manufacturing base. The Fed is probably a little less hawkish than they have been talking. So maybe they'll cut rates once or twice. They'll probably stop QT, enough to kind of support the market. And in combination with advancing the trade issue, that should kind of keep us in a range from the lows that we already saw to, call it like 4,900 to where that resistance was that Lance pointed out at the beginning. Mm-hmm. And then the worst case scenario is that we're just not making progress on trade agreements. The companies are continuing to pull back. They have to lay off employees. They're not investing into property, plants, and equipment. Consumers are holding back further. They're scared of being laid off. Basically, sentiment, which is very negative, turns into poor economic activity. And that's always the problem. These soft surveys are difficult because they don't always translate into economic activity. But the concern is that the longer they remain poor, the better the odds they translate into weaker economic growth. So then the question is, what's the downside? And the first thing to keep in mind is that we've already fallen 20% from the peak. So it's not like we're not pricing in, we're pricing in something bad. So when you talk about a 40% decline from peak to trough, we've done half of that already. Mm-hmm. So, potentially we're looking at another 20% downward. Doesn't mean it's all going to come at once, but it could be a little less of a roller coaster to get there. But again, and a Fed that's hawkish, that's the other key part of it. The Fed just doesn't relent, and just maybe they cut rates once, but they're really not being friendly to the market. There's, potentially a liquidity problem that's slowly popping up, credit issues that are popping up, and the market there's just not enough resolution on the economic front, the tariff front, to justify higher prices, and people want out. So, those are three wide scenarios. And what we have to do is kind of look at the foundation behind each forecast and judge how's it progressing. Is a deal with Japan and with the UK and Vietnam a good step in the right direction towards the good scenario? Or are fights with China going to push us towards the worst scenario? Or are we going to ride this roller coaster up and down all year?
So the answer to your question is you don't know.
Yes, we are.
All right, quick break. We'll come back, shift gears here just a little bit and talk a little bit about the basis trade. Obviously, rates are up. I'm getting we're getting lots of questions about interest rates, yields, where they go to next. What's the most likely outcome? Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Get ready for our next open chat edition of Candid Coffee with Richard Rosso and Michael Lebowitz, Saturday, May 3rd. Anything you want to know, we'll try to find the answer.
How do I deal with all this volatility?
Is now the time to buy bonds?
Has Danny been working out?
Register now and submit your probing question for Rich and Michael at realinvestmentadvice.com.
What's going to happen to Social Security?
Will the tariffs go away?
Where does Richard get his snappy jackets?
The open chat edition of Candid Coffee with Lebowitz and Rosso. Register at realinvestmentadvice.com.
Is that your bathrobe?
realinvestmentadvice.com.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Can we get to really big news today? Important news. Today is 110th anniversary of Oreos.
Oh, man.
They are celebrating it with a new Oreo cookie flavor called chocolate confetti cake.
Chocolate confetti cake.
Yeah, so 110 years. That just makes your whole day better. Doesn't matter how bad things are, eat an Oreo.
The Real Investment Show podcast.
When's the last time you had an Oreo?
1911.
At realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. Bear with me 1 second here. I'm just putting something together here for the show. There we are. Just real quick, I just wanted to, Mike was talking about a correction. He was saying, 20% could be another 20% lower. And, it's kind of an interesting comment when you say, you could have a 40% decline in the markets and immediately everybody goes, oh my gosh, right? That's financial crisis. And that's a big decline, right? So another 20% from here, that's a lot. Here's a long-term chart. Brent, all I need is the middle piece. I don't need the top or the bottom. I just need the picture of the chart. So here's a chart. This is a long-term chart of the S&P going back to 1920, right? And so... And what I did was I drew I put on an exponential growth trend line
through that period. So markets tend to trade above and below that exponential growth trend line over time. And that makes sense because markets trade off economic activity. So, sometimes markets can trade above economic growth rates. Sometimes they trade below it, depending on things that are going on. But the important thing is that we are currently so deviated from that long-term exponential growth trend. It would take a 43% decline just to get back to the growth trend. In other words, what that's saying is that you could have a 40% decline in the markets and still be in a bull market, right? This is the hard part for people to grasp, is that when, markets have become this deviated from long-term trends, you can have very, very big corrections and still be within a bullish trending market. You'd have to have actually, decline almost 50% to actually break that long-term bullish trend and get back into a position to where you say, okay, now we're actually in a bear market. That's a hard concept for people to kind of wrap their brains around when you're talking about bear markets versus bull markets. What's the difference between a bull market and a bear market? It's not a 20% decline, not when you're this deviated from long-term means. It's whatever changes the trend of prices from being bullish to bearish, right? And that's going to take a more substantial drawdown. So when Mike talks about, hey, we could be down another 20% from here, sounds horrible. And we certainly don't want to participate in that. Don't get me wrong. But we have to put this into context of how far and how deviated this market has gotten from long-term means. And this is one of the problems that when people are looking at charts, they go, well, you have to put that into a log scale. All log scale does is just basically mitigate the impact of large numbers. And so when you're talking, in other words, the difference between 100 and 200, it mitigates the impact. We're talking about the difference between 3,000 and 4,000 because those numbers are so much larger. So log scales are great for just trying to, put things into a more visible scale, particularly when you're talking about financial markets. But again, it doesn't mitigate or obfuscate the impact of declines, particularly when you're as deviated from long-term means as we currently are right now. Mike, any comments before we talk about the bond market?
No, there's actually a graph in my article too where I draw a trend line. Same concept. It doesn't look like you're saying, it doesn't look as bad as the graph you just showed, but it's the same. It gets you to the same dollar loss, the same percentage loss. The other thing to kind of consider are valuations. And valuations have been above normal now for 20 years, give or take a few periods, especially during 2008. So the question is, should valuations be above historical norms or should they be at historical norms kind of over longer periods? And I think that's a function of stimulus, of primarily monetary stimulus. So that's why the Fed was so important into kind of what I was saying there. If the Fed wants to help and they cut rates and they do QE and they do everything they've done for the last 20 years, we're probably looking at scenario A or B, right, and a tame version of scenario B. If the Fed's going to keep playing hawkish and hardball and so scared of yesterday's inflation, C becomes more likely. And this is kind of doesn't matter what happens with it does matter what happens with the tariffs, but it's equally important and because valuations are extended. So what there was a reader wrote something like, well, if you give all scenarios, you're bound to be right on one of them. Well, unfortunately, we don't have a crystal ball. And I wish we did, because then we would tell you whether it's going to be A, B, or C.
Right.
We don't. So what we can do is kind of lay out, here are the three things, here's what we think is most likely, and here's what you should be watching for to know which path to be on at the right time. Mm-hmm. And that's all we got. We have a magic 8 ball in the office, but it doesn't work so well.
I just asked Rich. Right. He's banned us from using the 8 ball on the show, so we can't use the magic 8 ball anymore.
Right.
But no, I mean, that's, this is always the interesting thing is that, and generally it's people of a more nasty nature, particularly in, they're, something has happened to them financially, either they're on the wrong side of the trade or whatever, so they're already upset. And then it's like when you lay out kind of possibilities versus probabilities. They're like, well, if you just name them all, you're going to get one of them right, and then you can say you were right. Well, that's not the point. Is not saying, hey, we were right. The goal is to say these are as investors, it's just like gambling, because we're betting on a future outcome that nobody has any idea about. It's the same as going into Vegas in the markets. And when you go to Vegas and you sit down at a blackjack table, you can have, and this is anybody that's played blackjack as an example, this has happened to them. They've got 20, right? They've got 2 10s. That's a pretty good hand. You're probably going to win that hand, and then the dealer draws 5 cards and gets a blackjack, right? Gets 21 and wins, right? That happens, right? That's a very low possibility. That's a very small possibility. It's a low probability event that's going to occur. So you bet on that. If you're holding 20, you bet on that hand. You've got a really high probability you're going to win, but it's not an absolute. And it's the same thing in the markets when you're investing, is that we have to understand that there are possibilities and there are probabilities, and we want to bet more on the probabilities, but we have to be aware of the possibilities of something that goes wrong. In fact, this is the subject of this weekend's newsletter. I'm writing about being Spock. The whole idea, if you ever watch Star Trek, see, this is how old I am. In fact, I was doing Charles Payne yesterday on Fox Business, and he said, in the last 25,000 trading days, this goes back to like 1929, there's been, only 7 events where you've had this many positive stocks in a row in a certain day. And I go, yeah, I've seen most of those. So, when you get as old as I am, it's just, you've seen a lot of this action in the past. But back in the late 60s was this show with William Shatner called Star Trek, and I know there's people watching the shows like, I have no idea what you're talking about, but yeah, there was this show, and Spock is this Vulcan from the planet Vulcan, and he has no emotions. This is the whole thing with him, is that he's purely based on logic. And everything with him is about measuring possibilities and probabilities of any event that they're going into. So if there's a battle approaching or whatever it is, it's like, if we do this, the probabilities are we'll be successful versus these possibilities. And so basically I took, 7 or 8 of his quotes from Star Trek, and I basically wrote an article talking about being a Vulcan when it comes to approaching your investing. And one of those specifically is talking about the bell curve of events. And it's very easy for us to look at the current environment and go, tariffs are going to lead to an economic crisis. Ray Dalio and all these other guys are out there saying, we're on the cusp of an economic collapse and de-dollarization and all these type of things. Maybe it's a possibility, but it's a very small possibility relative to the probabilities. Again, when you look at a bell curve of outcomes and you start talking about events that are 2 or 3 standard deviations or 4 standard deviations from the norm, these kind of more exogenous events like the financial crisis, those are things that can occur, and we need to be aware of them. But they're very small possibility events versus the probabilities of what markets are going to wind up doing. And so we have to bet and manage the risk accordingly, but be aware of those tail risk and make sure that the portfolio is hedged against the possibility that tail risk actually occurs. Mike?
Even 1987, there were telltale signs that the market was in trouble. No one predicted, I think actually someone did predict a large decline, but no one predicted that the massacre that the market saw. But there were telltale signs that you should not be running at full exposure. There was I wrote an article about this a couple of years ago. There were technical signs, there were political indicators, there were reasons that you should not have been running at full exposure. So the market is always giving signs. We talk about it with basis trades. There's a liquidity problem. It's not a disaster right now, and maybe it's being solved, but kind of behind the scenes. But there are so many different indicators we can look at. And it's, Lance, it's very easy to be negative, but there are positives to all this tariff stuff too. If we come to agreements that are less than what we have now, we're in a better place. If we don't have to tariff a country and they reduce their tariffs, we're in a better place than we were before. So this may not be a tit for tat tariff type of thing. This could be a very beneficial exercise too in the long run.
So I got sidetracked with that. Apologize. We'll come back. We'll talk about the basis trade, yields, bonds, what happens next in the bond market. That's got everybody's attention right now. Don't go away. We'll cover that next.
Investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Get ready for our next open chat edition of Candid Coffee with Richard Rosso and Michael Lebowitz, Saturday, May 3rd. Anything you want to know, we'll try to find the answer.
How do I deal with all this volatility?
Is now the time to buy bonds?
Has Danny been working out?
Register now and submit your probing question for Rich and Michael at realinvestmentadvice.com.
What's going to happen to Social Security?
Will the tariffs go away?
Where does Richard get his snappy jackets?
The open chat edition of Candid Coffee with Lebowitz and Rosso. Register at realinvestmentadvice.com.
Is that your bathrobe?
realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. So one of the, top 10 questions over the past couple of weeks that I get by email is, what's happening with yields? Yields have jumped up here got up to around 4.5%. We talked a little bit. We spent a good bit of time here on the show the day that occurred. We had 3 days where yields just kind of went straight up. We got down below 4%. As economic data was really starting to show signs of weakening and inflation was dropping. We printed 2.4% on inflation. So, the economy is slowing down, inflation is slowing down. Why are yields going up? What's happening there? And we spent a good bit of time talking about the basis trade. And in fact, if you go to our YouTube channel, which if you're watching the show right now on YouTube, then please like and subscribe while you're here. We appreciate it. But on the actual homepage of the YouTube channel, there's a pinned video talking about the basis trade, what it is. So I'm directing you there for the explanation what the basis trade is, so we don't have to spend a lot of time covering the basics. We can just move forward and talk about what happens next. But Mike, this is kind of the big concern for markets. Again, the one thing that we have always said is that, if you're expecting a 40% decline in the markets, it's not a recession that's going to just a garden variety recession is not going to create a 40% decline in the markets. You're going to need some type of event to occur along with that recession or because of that recession. And generally, those are more credit related in general. The dot-com crash, everybody says, well, it was the dot-com bubble. Yeah, it was, but there were major corporations that were going out of business, Enron, WorldCom, Global Crossing, et cetera, that put the credit markets into a lot of trouble. Same thing in 2008 with the financial crisis, the Lehman failure, the shutdown of counterparty trading between banks, huge threat to the credit markets. You're going to need some type of event that comes from the credit-related area, and kind of one of your telltale signs of that is spiking interest rates. Obviously, if rates are spiking up very sharply and not being driven by economics, which they should be, then there's something certainly happening within the bond market, a liquidity issue or a credit issue or something that we need to pay attention to. And that was the basis trade we saw a couple of weeks ago, that kind of deleveraging. Are we past that? What is, are we still in it? Is that still a risk? And kind of what should we expect, over the course of the next few weeks? But most importantly, to include in your answer, is despite the Fed's view on inflation and full employment, at the end of the day, what drives their decisions is the credit market, and at some point they act to bail that out. So go ahead. What are your thoughts?
So two things. First of all, remember that in 2020, 2021, the Fed flooded the market with liquidity, and there was excess liquidity. And because of the overnight repo facility, we could track it. We knew what it was. They every day they'd come out and they'd tell you what it was. It got up as high as 2.4 trillion, 2.7, I want to say 2.4 trillion. That's excess liquidity. That's a massive amount of excess liquidity in the system. Since then, it's been drawn down to zero, or just about zero. That tells us that there is no more excess liquidity in the system. There's still ample liquidity, but not excess. That's part A. Part B is that we've had a drawdown in many asset prices, stocks, bonds, yield, stocks, bonds, crypto, you name it. We're in very highly leveraged financial markets. So when you are buying something on leverage, you have to post collateral. And when the price of something goes down, you have to post more collateral. So that extra collateral that's needed, is causing some liquidity issues. Not a crisis, but it's further draining liquidity. When prices go up, like we've seen, last couple of days, that eases some of the liquidity conditions. And that's one reason why stocks are trading with bonds. It's telling you there's an underlying liquidity, not crisis, but shortage.
Concern.
We're lacking liquidity. And it can be problematic, but that's the big deal. And that's why the Fed cut QT, right? Mm-hmm. There was no real rationale for why they were doing it. They just did it. And it wouldn't surprise me if they cut QT completely at the May meeting, or at least cut it for treasuries. I don't know what they're going to do with mortgages. I don't think they're going to go to QE, but if the liquidity crisis brews and there's real problems, you could see them doing QE in a week, because that's how they inject liquidity into the system, or some other sort of program that's QE-like.
Right. So, and just real quick, Mike, just a quick reminder for individuals, that this reminds me a lot of 2018. This whole spat between Trump and Powell reminds me a lot of 2018. In 2018, the market's declining, the Fed's trying to hike rates, we're nowhere near the neutral rate, and Trump's demanding that Powell cut rates, and he's not cutting rates. But then by June of 2019, all of a sudden he's cutting rates back to zero because we're having this whole repo crisis going on. So, one thing that Trump may be right is that Jerome Powell does tend to be late to take action.
Right.
And, we certainly have a credit risk. We do have a risk brewing within the bond market. And he's not taking action at this point. But again, the point is that can change very quickly. If there's a risk to the bond markets, the credit markets, et cetera, regardless of what Powell's saying today about we're not going to cut rates, we're not going to do anything, that can change very quickly with him.
And if I were Trump, I wouldn't be getting on rates. I'd be getting on QE.
Yeah.
I would. That's the one I would be getting on. QE can fix the markets pretty quickly. And if the markets are trading better, you get the wealth effect, and that can offset a lot of this bad tariff news and uncertainty. So, the QE is probably the bigger one of the two. We've kind of not gotten used to rates this high, but it's, we're functioning with rates this high. QE could really provide a little spark to the markets, and importantly, just provide the liquidity the markets need to withstand this volatility. This is incredible volatility we're seeing. And when you're posting collateral, it's a combination of two things. It's how far has the price changed and how much liquidity is there. It's kind of like option pricing. And the more liquidity, the more volatility, the more collateral that the counterparty is going to demand of you, in addition to however much that asset has fallen in prices. So again, the more volatility that we're going to see, if that's possible, VIX has come down decently, but generally the more volatility and the lower asset prices, the more that people will need liquidity and will drain it from the system till it becomes a problem at some point.
Yeah, and like I said, I think the two things to walk away from this conversation with is, one, what do you think the Fed does in May? And two, do you think interest rates have kind of seen their recent peak, and do we start to kind of trend back towards where economics suggest rates would be, or is there still more of this basis trade problem brewing?
It's the basis trade is probably there. There's liquidity problems, but I think the stock market is going to trade with the bond market is going to trade with the stock market for liquidity reasons and for uncertainty reasons. So at some point, I think the Fed would step in, the Treasury would step in, but that's probably 5% yields. That 5% magic number is where the Treasury has some tools that they can use, where the Fed also has kind of behind the scenes tools, but they could do QE, they can do other things as well. Operation Twist is one. So I think we're kind of range bound, but like the stock market, a very wide range. What's important is to see how the bond market reacts to fundamental news. We've seen 2 months in a row of good inflation numbers, lower than expected. And we really have yet to see hard data really pointing to a slowdown of the economy. There's things here and there, but most of those are kind of survey sentiment data. The employment data remains decent, right? It's not really changed that much. And there aren't big, retail sales has been okay. And there's also been, tariff buying in advance, front running. There's a lot of things going on. So what I really want to see is how do bonds react to bad economic news, to much weaker economic growth than expected. And if inflation continues to come down, does it start to realize that tariffs can be deflationary? It's not necessarily inflationary like everyone else seems to have their mind set on.
So I guess, the kind of just to sum up, kind of our whole conversation this morning with the markets in general is that, again, there's no certainty about where we go to next, but what's important is just trying to navigate the risk with, and again, this kind of goes back to everything we've been talking about over the last several weeks, is about minimizing emotions, not making big emotional decisions, not making big trades in portfolios, and understand that when, and we saw this, we talked about this a couple of days ago, is that, when this market rallies, as an example, gold will be a source of liquidity for the markets. We saw gold sell off, stocks go up. And that's going to be this case. So, again, don't forget to take profits. Don't forget to rebalance risks. Don't forget to, manage that cash exposure within portfolios to navigate this volatility. Because again, if Mike's right, as we talked about this morning, we could be spending several months, if not longer, just trading sideways and just going up and down, back and forth. And it's just going to be this grind. So we're going to have to be a lot more active about managing portfolios here near term, taking some trading opportunities when we can get them, take profits when you have them, and then look to redeploy that cash at lower prices when you get them. So again, there you go. All right, have a great day. Richard Rosso here tomorrow for Financial Fitness Friday. See you back here on Monday. Have a great day.